bank earnings keep climbing, reaching new records again in 2015. But with all the global and domestic challenges out there, can they keep it up? Today we dig into Canadian bank earnings with Doug Warwick, portfolio manager of the TD Dividend Growth, TD Dividend Income, and TD Monthly Income Funds. Good to have you back, Doug. What did you think of those bank earnings this quarter?
Well, the earnings were actually not too bad when you consider sluggish world economy, poor Canadian economy. Quarter over quarter, Canadian bank earnings were down 2%, but year over year, the reported number was up 9%. Now you have to adjust that a bit for extraordinaries. So we would call the quarter maybe noisy or messy. So we come in, probably the banks were up between 6 and 7% year on year, which is not a bad result considering.
Now, was there anything big that stuck out to you from last quarter?
You know, it continues to surprise me that Canadian retail continues to slog along at mid-single-digit growth rates. So that was encouraging. Wealth for most of the banks did pretty well. Capital markets were weak, which was, you could see that coming. I suppose last quarter we were surprised by Commerce increasing their dividend the fourth quarter in a row. So when they did it the fifth quarter in a row, we actually weren't surprised.
So if you're looking ahead, what would you say would be the biggest challenge for the banks?
The big concerns with the banks are oil and gas loans and the high leverage of the Canadian consumer. So if we look at oil and gas loans, the average Canadian bank, the loan book is 2% oil and gas. So it's not large. The biggest exposure is 3%. So, and these have, they're investment grade loans. I don't. There might be an increase in provisions if the price of oil stays lower for longer, but I just can't see how this will really impair a bank. But so then what you do is you look over on the consumer side, and if you consider that Canada is really two parts. You've got the oil and gas exposed provinces, so Alberta, Saskatchewan, and that's where you get knock-on effects from the low oil onto the consumer balance sheet. So 18 to 20% of mortgage loans would be done in those two provinces. So the correlation with higher consumer loan losses would be higher unemployment rates, and you're starting to see Alberta unemployment tick up. I think the latest number is 7%, which is now actually above the Canadian average for the first time in many years. So I would expect a tick up in loan losses from that. But then look at the rest of Canada. Ontario, Quebec, for example, benefit from a lower dollar and from lower energy prices. So manufacturing is maybe 10.5–11% of the Canadian economy, but that should benefit. Our largest trading partner, the U.S., is actually in great shape. They've got a high dollar. U.S. consumer is in great shape, and so it's not all dire for the Canadian banks. But you do worry. The consumer loan to income ratio is 165%. There's the kind of mega borrowers who are as high as 500% of income. That's a small percentage. So we'll be watching those, and that's primarily in the Toronto and Vancouver markets. But by and large, remember, half the Canadians own their home outright, and the other half who do have a mortgage have at least 40% equity in their home. So it would take quite a hit to house prices to really start to impair bank earnings. And remember, any high ratio mortgage is insured, so that covers the first 20% of a downturn. So the long answer.
So with interest rates expected to rise then, are there any areas of financial services that would benefit from this?
We've been hoping, I guess, for a small rise in rates for many years. We may see that the end of the year in the U.S., although some recent numbers are the Purchasing Managers Index and a few of those indicators would probably indicate that the U.S. Fed should delay an increase, but we still might get a bit of an increase at the end of this year because it's been talked about for so long. We don't expect that to happen in Canada for quite some time, probably for at least 2016. So not a concern for the consumer. But if you're interested in the leverage, a 1% rise in interest rates, if the bank were to keep all of the benefit, the average bank, it would give them double-digit increases in earnings. So it would be higher rates. It's very difficult for banks to make a decent net interest margin at these very low rates. Banks don't like really high rates either because it hurts their customer, but something a little higher than what it is now. So higher rates would definitely benefit the banks and the insurance companies, but we don't really expect that in the medium term for Canadian banks.
Now, what about, do you have a favorite stock or something that's good value right now that you're looking at?
If you look at the Canadian bank group in general, we're trading at 10.1 times forward earnings, so very cheap, 1.6 times book value, again, very cheap historically. So the group does look like reasonable value. Probably what you should do is go for the banks with wealth exposure or non-Canadian exposure. That seems to be more in favor. So that would mean TD and Bank of Montreal for U.S. exposure or Royal Bank for wealth exposure. A lot of it, money has been leaving the Canadian market, and really what we need, a perk up in the price of energy would get some money going back to Canada, and that would really help the valuations of everything in the Canadian market. And I believe that will happen sometime in 2016.
All right, we'll look forward to that. Thank you very much, Doug.
Thank you.
I've been joined by Doug Warwick, Portfolio Manager from TD Asset Management. I'm MaryAnn. Thanks for watching.